Hello, everyone, and welcome to the Market Huddle for November 9th of 2018. This is episode number 1, and even though we have done 5 prior pilot episodes, this is actually officially number 1. My name is Patrick Ceresna.
And I'm Kevin Muir. It's great to be joining you today, Patrick.
Oh, thank you. And so, first off, let's get all the stuff out of the way. What's on the menu here?
Well, let's start with our sponsor. We were lucky enough to have Bob Cajun Brewing Company sponsor us this episode, and we're drinking a beer called Birch Bark. So let's get going and crack this open.
Oh, that's fantastic. Let's see it.
You know, I chose a sponsor. You know, there's a lot of people beating down the door to be the sponsors of the first episode of the Market Huddle, but I chose Bob Cajun because I felt it was a true Canadian beer, and there's that great Tragically Hip song, Bob Cajun, and for our American audience that doesn't know it, you should go and Google it and listen to it because it's true Canadiana, and this is a terrific beer.
It is good.
And one last thing before we get going, I have to do my legal stuff, and so let's get that out of the way, Patrick. Clients and employees of East West Investment Management may hold positions in securities mentioned in this podcast. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. For more information, please visit eastwestfunds.com.
You changed it from last week. What was?
Yeah, well, there was no hot dog fingers and all the other stuff that you can get.
Let's start off with you, Kev. What was the biggest thing for you in this past week?
Well, it has to be the midterms. That was the midterm elections. The market was on pins and needles waiting for it. And there was all sorts of worry that there was going to be a problem in terms of either the Democrats were going to win both houses, or even maybe some people were worried the Republicans were going to win both houses. It ended up being split.
All right. So as everyone's watching this little GIF video here, so I want you to keep giving your opinion, but just quickly tell people what they're looking at here.
Well, what I created was there was all sorts of people going through on Twitter talking about how the midterm election cycle over the past, since World War II, every single 12-month period after the midterm elections has resulted in the stock market being up. And I'm a big fan of Ronald Reagan, who said, trust but verify. So I thought to myself, well, I better go have a look at this and make sure that they're correct. So I made this great GIF that went through all of them, and sure enough, they're correct. There was, speaking of Ronald Reagan, the one that almost didn't work was the 1986 midterm that it was the preceding 12 months had 1987, and it had the crash in there, but it managed to squeak out a win, and it was 1%. And so think about that, the last 18 midterms, every single 12-month period after this November date has seen the S&P be up on that year.
So in theory, we could drop 30%, rally 30%, and be up on the year, and you'll still be right.
That's correct. But when you watch them scroll by, you see that most of them had very little drawdown. There was the occasional one that was 5 and maybe a 10, and there's some from way back when. I think
Trump has a date with inevitability here.
That's right. Well, we'll see if it'll be a Ronald Reagan type situation where you have a big crash, or whether it'll be just a Clinton one that's coming up here that you see it just chugged higher time and time again. But I think the really interesting thing that we should talk about is the market reaction to the actual midterm results. And why don't we pull up, we've seen enough of the presidents going by with all the different periods. Why don't we pull up and go have a look at the actual intraday chart of this week and see what happened?
Sure. All right. So let's take a look. So we're going to look at the S&P futures, okay?
Yeah. And there was a lot of, let's say, angst, because don't forget, 2 years ago, President Trump won, and that night was quite the night of rock and rolling all over the map, right? So to say that investors were cautious is probably a little bit of an understatement. And the interesting thing that I think that occurred was that even though the results ended up being almost exactly what everyone predicted, there was no real big surprise. Would you agree with that?
Yeah, the market said to a 65% probability that this was going to be the outcome.
Yeah, and even though there was no big surprise, the market, the S&P took off like it stole something, right? Where is it on that chart there?
Right. Oh, yeah. So right here. So the election reaction was this little pop right up in here.
Right, and you could see it. It just started to run like it just stole something, and I had a lot of people coming to me and saying, like, "Why is this? Why would it be rallying, given that this is what the market expected?" And I go back to my study that I created on that my macro tourist post. When I published that, the feedback that I got was universally, "This time is different." I can't tell you the number of people that...
I was about to say it, too.
Yeah, you were about to say this time is different, right? And one of my favorite responses, and the fellow who wrote me, if you're listening to this, I love you to death, but I kind of laughed because he said, "Trump is a total trend buster on so many levels. You've just guaranteed," he's talking about me by writing that post, "you've just guaranteed a down market for the next 12 months starting tomorrow." So he was saying that me bringing this to everyone's attention guaranteed it. And I responded, I said, "I'm the first guy to laugh at myself, but I'm being swamped by comments like yours." So to me, it was very clear that the market is set up with people being very short and very looking for some negative reaction going into the election. And I think it just when it ended up being, it was one of those things. It was sell the rumor, buy the news. It was almost the opposite of what everyone expected.
I think that, and you can comment on this. My feeling is that it's kind of convenient that the kind of more or less 8-year presidential cycle, like every 4 years, but the terms come up in that way. It sort of lines up very nicely with what is traditionally something in that 7 to 10-year business cycle. And so, in my mind, a lot of times, I think that it's easy for us to look at the cycle of trends that happen when a president is elected. But I'm curious to do a study to see how much the actual business cycles themselves line up with the presidential cycles.
Well, but you're correct that the presidents are making the business cycles to some extent. Think about Trump; he timed it so that his fiscal kind of stimulus was coinciding with when he gets elected. Right. And if you're sitting there trying to decide when to spend some money, you spend it at the most opportune time to get yourself reelected.
Sure.
And so that to me is why this works, and it's worked for so many.
Obama basically had an entire term, a 2-term presidency without a recession. He started in a recession, but basically he had an entire up market. And the Trump now is 2 years into his presidency, and we still haven't had a recession. So are you suggesting, just like the Treasury and Donald Trump, that we're going to have like a 15, 16-year period without a recession?
Well, all I'm suggesting is that he probably timed his spending to do maximum good for himself getting reelected, and therefore that's why we're feeling the kind of the joy, the positive effects. So
with the Democrats in power in the Congress now, how does this play out in terms of Trump being able to juice up the?
Well, he's already spent it. So the real question is has it been spent, and is it going to peter out?
You don't think going into 2020, right into his bid to win the presidency second time in a row, that he's not going to juice it up?
Well, I think he's going to keep juicing it up as much as he can all the time. I think it's the new reality.
Sure, but are the Democrats going to let it? That's a good question.
I don't know. That is a good question, and I'm not really sure. So what do you think? Do you think that do you think Trump is the first president where this 18 these past 18 times since 1946?
I will take the other side of this for you. I will. Let's make a gentleman's bet on this one. I feel that we're heading into some form of a downturn. How it plays out is yet to be seen, but I think that there's a very good chance that this is going to be a break of that 18 President Trump.
Okay, well, there you go. You heard it, folks. What should we do? The Duke and Duke special, $1?
Oh, yes.
Yeah, okay. So
$1.
$1. So we're going to come back a year from now and see. So, Patrick, what did you think the biggest story of the week was?
Well, what I chose really was to want to talk about oil markets. And, the big headline, of course, was oil's whenever any market drops more than 20%, it's an official bear market, right? It's
such bullshit, isn't it? Like, it's such an arbitrary number, and it's like, and anytime it's making the Market Watch headlines and making it on CNBC, it just makes me want to grab a stack of blue tickets.
Oh, absolutely. And it's interesting is, listen, I'm an avid technical analyst. I really enjoy doing my charting.
The squiggles.
I love the squiggles. But with that said, it's interesting is that a lot of people love the golden cross and the death cross, which is the cross of the 200-day and the 50-day moving averages. And if you think about this, right? So a 50-day moving average is the average price of the last 50 days. And it's got to have enough juice to make it all the way to the long-term 200-day moving average. That's a lot of selling or a lot of buying that has to basically happen in order for these two lines to cross. And what I love is that somehow this is a market timing signal. Give me a break. By the time the 50-day moving average makes it for a death cross all the way down to the 200-day, you probably have an epic buying opportunity, not a new sell signal, right? And in the same way, we're a bear market after 20%. Well,
it would be interesting to get some of the quant guys to have a look at that study and see if there's any validity to that, or even in fact if it goes the other way and that it actually is a buying.
I'm going to do that. I'm going to start doing my homework, and we'll see what actually happens there. But with that said, oil. Let me actually pull up an oil chart here for everyone to check out. And the one thing that I'm want to just point out is, okay, look, that was a pretty crazy drop, right? Like, I think this was the biggest drop in 34 years or something.
Yeah, no, it's a long time. I think it beat the drop of the 2015 bear market. It was
in
worse.
Terms of sustained selling.
That's right, and it was
because what is it like when there's a reaction, it resets, right, or something?
I'm not sure. It's down 18 of the last 20 days or some crazy number like that. Yeah. It's trading like death. It looks like the Grim Reaper.
Absolutely, yeah. But the question that I wanted to ask: are we going to have this short-term low here? And this is an interesting thing to ponder. Admittedly, I have touched the stove and gotten burned now 2 times, but it's not enough to have 2 burns on my fingers.
Right. Well, no, tell me the line you told me earlier today that I think is the greatest line ever in terms of...
Which is that I like to catch falling knives, but I wear a chainmail glove.
That's right. I thought that was just a terrific line. That makes me laugh.
Because listen, I went in there, I attempted to first buy crude oil, fade this heavy selling around the 65 level, got knocked out. I had the hedge, but I moved to the sideline with the trade. I tried it again in the kind of $62 range. No, I pulled the plug on it again, and here I am, the third time in like 3 weeks, in the last 2 weeks, that I'm trying to catch the bottom in oil again. So 2 times burned wasn't enough for me.
I think there's a market wizard that I can't remember what book it was, but they talked about that. The fact that they said something to the effect that. If it was Paul Tudor Jones or somebody like that, and they said he catches the bottom of the market, and he said when Paul Tudor was talking about it, he said, yeah, but what people don't realize is that I tried it 4 times before I finally caught the bottom.
Right.
And that was it. And they
you have to test it.
Yeah.
You have to test, and because what happens is that the only way to find out whether you've caught a bottom is you got to put in a stake. You got to put your foot in the water, and you then are studying the price action in terms of whether other buyers are reacting here, whether you're seeing the conditions change. And if it's not, and you realize you're early, you have to move to the sideline and reset the trade. You can't just stay in and keep getting burned over and over again. You have to kind of discover where you're going to find that bottom, right?
Yeah, you can't cannonball and just keep adding to it or whatever.
Well, there are a few people that try that, and often that ends very badly, right? But so anyway, big drop. It's very interesting. But what's also interesting is the impact that this has had on a lot of the different energy companies, right? And more importantly, what I want to touch on, as Canadians, we can all talk about West Texas Intermediate, but what about the Western Canadian Select Oil, Kev?
It's just brutal. The spread.
What about that Canadian?
Take off, eh? So for people that don't know, there's a different kind of grade of crude that is basically
bitumen.
Oh, there you go. So you know all the lingo and stuff, but it's stuck in Western Canada, and it's having
heavy crude. Yeah, but Venezuela has some too.
Well, that's correct, but it's having basically because of our batshit crazy energy policies and our lack of being able to have proper pipelines. We have a whole bunch of energy that is oil that is trapped out west. And actually, interestingly enough, we're talking about this today, and I see that the Keystone got delayed again by some judge. Mm-hmm. And it's just, once again, it's another story of Canadian crude oil and trading at a huge discount. So you just brought up the chart, and you see that Western WTI trades at $60, but the stuff in Canada gets $27.
And the spread, and that spread right now is $33, but it was bigger. There was I think maybe I'm bullying. I swear I saw almost a $40 spread at one point. I mean, that was probably when it was up in 70, and then we were trading near 30 or something.
I saw this editorial kind of comment in the Seattle newspaper where the guy just was laughing at us and saying, "You Canadians are absolutely nuts that you're sitting there with your oil selling it at this huge discount because you can't get your acting gear to get it down to."
But really, the pipelines to the U.S. have to be approved in the U.S. Not yes, there's the pipelines in BC and stuff like that are being kiboshed as well, right? But
you're that is correct. That is something that's a good way to look at it. But at the same time, we should be worrying if we can't sell to the U.S. We should be trying to sell it somewhere else. Or we should be developing.
But isn't that what the pipeline out into to BC was all about, to get it to some sort of place where they can ship it?
Yeah, and then you see how much of a problem that ended up being for the American.
It's all stuck in Alberta.
Yeah, and it's just our poor Albertan kind of listeners. They do not think that highly of the federal Canadian government, to say the least.
Well, they're trying to get it pushed through, right?
Right. I completely agree, and they're frustrated. And they've now had one Trudeau from in the 70s with the National Energy Program that they hated, and now they have another Trudeau that they're frustrated with that isn't doing the right thing for them. Absolutely. But regardless, we should talk about the markets. That's what we're here about.
All right. Before we get to the stocks, actually, I forgot to mention. I wanted to actually get your take on this. But one thing that when in the Macro Voices podcast, when I was talking with Eric, he was talking about the term structure in the oil market, and I thought this was really interesting. Now, for our listeners that don't understand term structure, essentially each futures contract has a slightly different price based upon the perceived inventory that will be in the future.
Well, it's actually a delivery. Different months that you deliver into.
Yes.
So there's the near month, and then you can deliver. You can buy crude oil a year out, 2 years out, 10 years out.
Right, and so it's the supply and perceived supply and demand in the future at those 1 or 2 or 3 years that affects the prices at those times.
Right.
And so one thing that you can see on this chart, which is the light dotted line, which is the term structure a month ago, which was that spot price was up near $75, $77 on the upside. And yet, though, if you were going, actually, I can't believe I cut off the actual dates, but if you in the middle here, it's somewhere like
Yeah, so you go out
2023.
5 years or
Yeah,
something.
you're going out 5 years in oil. You there, it was trading down at $60 already, and so there was the spot price was essentially trading easily $10+ over that of the long-term price of oil. And what was amazing is that this crash in oil was not the whole term structure collapsing. It was just the front end. The front end, there was a huge backwardation in this curve.
Right.
I guess it was, some people say it was Saudi Arabia or whatever that was driving the backwardation in the first place. Maybe the risks in the Middle East or whatever were the drivers. And now that we've seen this collapse, the yellow dot, the strong yellow dotted dots are the term structure today, which we went from pure backwardation to even a little bit of steepening in this curve right. at this moment. It's almost like oil overshot.
Right. So it's if you can't see it and you're just listening, the front month went from $75 down to $61.
Right.
But yet if you go out the curve and you go out 5 years, 5 years from now, that contract went from 62.5 to maybe 61.5.
Yeah, if you were trading those longer term, you experience no drop.
That's right. And the interesting thing about that is that if you're a company that is producing oil, you're not selling at the front end of the curve. You're actually hedging out in a strip, and you're actually the whole kind of value of the strip means a lot more than actually what the near term front month's trading at. So to some extent, this is probably worse than it looks. This decline.
It is worse than it looks?
Sorry, it's not as bad as it looks. You're absolutely right. So it's and that just
for energy companies, that is.
Yeah, and just the whole.
But not if you're an investor.
No, but maybe
like if you're trading oil futures contract, you got hit here because you're trading the liquid front month.
But you might not be. Like a lot of oil guys are trading different months. But you're right. If you're trading the spot month and you're just banging around oil, it's been a lot. There's been a crazy ride. Like it's been that whole kind of 75 down to 60. So it's been $15 or $12 or whatever that you've lost in a space of a month. So that's been huge that way. But for longer term investors that are buying stocks and that are trading kind of something that without as much zip, the oil hasn't moved as much as it looks like it has. Is my point.
Right. Well, that's definitely interesting to see. So let's summarize. So we have a massive drop in the front month. So the oil price that we look at always, this one right over here, this is the price of the front.
That's right.
Right. And so the front month collapsed, and as this collapsed, it caused the front light yellow dotted line to collapse down to where the dark yellow is today, right? And so we had that complete collapse. Now, we had this obviously happen. So let's talk about energy companies, and let's talk about the impact that this has had. Now, we're using the XLE, which is the energy stock ETF that baskets all of them. We obviously had a big dump, but surprisingly bounced. And in the last wave, where we went from like 65 down to 60, energy stocks are actually up versus down. Now, obviously, that's from the index. When the stock market bottomed and index buying came in, they were scooping up Exxon, Chevron, and everything that has a huge weighting in the S&P 500, and your index buyers were pushing the price higher. So really what we're seeing is a lack of response in the last push lower, where energy stocks never dropped with it. But what's amazing to me is the tale about the different groupings of stocks within this energy basket. So like, okay, the majors, if you notice this chart on the XLE and we use Exxon, you can see where that chart came from, right? You had a sell-off and a bounce. It looks fine. But what if we go to oil services? What if we go to the refiners? What if we go to the Canadian energy companies? It's amazing how they're all over the map with some of these different things.
Which provides a lot of opportunities for people that are...
Okay, so I'm curious what you think is an opportunity.
Well, so
which one you want to start with?
Well, why don't you go with the ones that you were telling me earlier about how you got you.
Yeah. So I've been naked put writing on Phillips 66, right? So here we got an oil.
So wait 1 second. So the guy who tells me all about like all that he buys protection and stuff like that, and then he's like, "Oh, I'm just naked put writing these."
You know what's funny is, often what I will do is when I'll sell a longer dated naked put, and I might buy a very short-term put as a hedge. So I'll go like a 6-month long-dated put, right, and I'll just buy a 30-day short-term hedge just to, like a chainmail glove, to test whether or not I caught the turn.
Okay.
So I'll do that. But this time I actually did to go naked.
Okay.
So we went and we just sold puts outright. I did go to the lower strike, so I've got a cushion. I'm down like at the down at the 90 strike, right down below. But it's interesting. They didn't bounce the way that the majors did, right? And so I was thinking they would get a little bit of a bigger response in the Phillips 66, like another one like Valera. I was kind of breakout trading the upside of Valero here on the upside, not responding as well. But what's your take on the refiners?
Well, I'm not actually playing those. For me, the real opportunity lies, we go back to that Western Canadian Select and the problems that we have in terms of getting our oil out of Canada. And the market has destroyed Canadian oil stocks. They've just been hammered. Just
Cenovus. You want me to go Cenovus?
So sure, let's go Cenovus.
This is the Canadian Cenovus. Do you want me to show it in the U.S. dollar price or Canadian?
No, it doesn't matter. Whatever. But I think we're now reaching a point where a few things are happening that the market's going to start looking ahead, and I think the stock market is always a discounting mechanism.
always look at.
And I look at I think to myself, what are the surprises that are going to happen? And I kind of look at Cenovus, and I believe that first of all that spread between WTI and Western Canadian Select is probably hit the widest it's going to hit, and that Cenovus has gone and done a whole bunch of rail deals with different companies to get their crude down to the refiners in the States. And interestingly enough, with the Venezuela going offline, the heavy oil, which used to trade at a discount, is now trading at a premium.
Well, sure, because what happens, a lot of the shale oil is not actually refiner ready. We had a great special on Macro Voices going back when we were talking oil back then. And what was interesting is, they could pump out all this oil, but they actually need to blend it with the heavy bitumen oil in order to get a refiner ready. So you can pump out all of this light stuff that's coming out from fracking, but they need that heavy oil to create the blend.
Right. And with Venezuela not being there to deliver that heavy oil that used to be so easily,
they need the Canadian stuff.
They need the Canadian stuff. And so I look at Cenovus, and I think there's a real opportunity there. Cenovus, CNQ.
Yeah. So, well, first of all, I put on right now Cenovus here on the U.S. dollar price because a lot of our listeners are not going to just go to the Canadian. So it's CVE actually both in the U.S. and Canada.
That's
so it's
right.
the same. And actually same with CNQ. So I'll look at CNQ as it trades on the New York Stock Exchange,
right.
And so look at that. That's been murdered. That was a darling,
right? And I think that they've had to shut stuff in because they've had trouble getting it out. And I heard the CEO screaming about the fact that certain other kind of refiners and large majors are playing games. But I think that these stocks are at a point where the worst of the bad news is behind us.
Okay.
And from now, the surprises are going to be the other way from now, is what I'm looking at.
That's interesting. I mean, it's possible. But going back to 2016, you had Canadian Natural Resources trading down at $16. The thing bottoms down at 16, rips to 38. There was a huge return in 2017 into 2018 on it. I mean, look, the thing went from 38 to 28. Yeah, $10 to the downside seems like a lot. But when you kind of put it in context, we're sort of still in the middle of the range from where it was from the top to the bottom. I mean, this was, as much as this looks like a 2-month bloodbath, when you really look at where we were in the last 4 years, we're sort of in the middle of that range. Where am I getting wrong?
No, That's an interesting way to look at it, and I find that often the short-term traders will get too kind of myopic and looking at the kind of the last month and going, oh my God, and then when you kind of take zoom out, and all of a sudden you say, hey, this isn't that big a deal. Why are you guys so upset about this? And you can do your fancy Fibonacci stuff, and
that's almost a 50% return.
Yeah, and I tend to agree that. Why are we getting so excited about it? Like, let's even go back to oil. Like, we're getting all excited about 14 or like 12 bucks.
Yeah,
but
like, on the bigger scale, this is not that huge of a move. I mean,
like,
I think what the big chart. This is a weekly chart. So like when you put it in context, I mean, this was a pretty ugly 5 weeks, but it is nothing in comparison to what we witnessed when we look back at this drop right over here, right? Like when you look back at this drop and you're saying, this was somehow incomparable. I mean, this is nothing in comparison, right? The question, of course, though, is, okay, look, here I am trying to be a rock star hero and catching the bottom on oil.
Even with your Teflon gloves.
With my Teflon gloves. But I'll tell you, I mean, are there enough bearish circumstances that this thing could just do a deja vu 2000? Now, I'm not saying, look, I'm not thinking oil's going to zero or some crazy thing, because I saw you were thinking of how you're gonna fucking call me out on us, but in the end, we are looking at here though is that when selling gets this intense, look at it when you go back to 2015 during that drop. It just never stopped. Every time you thought that was the end, it just kept getting worse and worse and worse and deeper in the selling, and just didn't quit.
It was relentless.
Yeah. Is it possible?
Well, anything's possible. A good trader learns to never say never.
So
there's no doubt that that this might just be the start. Whether I would bet on that, no. I would definitely take the other side of that trade. I think that we're going to find that basically, I think we're having a little bit of a growth scare in the whole kind of global markets, and this is part of that issue. And I think as these things come in, and as the Fed and other central banks ease up on their tightening, and I know you're going to be like, whoa, they're not they're not easing up on their tightening. They're just keep going. I think that I think the next move for the Federal Reserve is to ease up on the amount of tightening that they're doing, and that will react positively, and I think you'll find that oil will bounce. I think I think that
well, my wallet hopes you're right.
Yeah, no, I definitely think that that this is just a function of the crude oil market catching up with the global kind of hiccup that we've had in terms of growth. So I think to be an oil bear from here, you need to assume that the global growth is going to collapse. So if you're one of those doomsayers that thinks that all of a sudden,
I think we're due for a recession, and I think there's going to be an economic contraction. I don't want to be a doomsdayer that thinks that this is going to be the Peter Schiff moment. I just think that we're overdue. And you're seeing the decay in the emerging markets and other places like this that are may very well be signaling the fact that a global slowdown may be in its early stage. And think about it, like for instance, the global stock markets have not. They put their highs in January. We're a year of stock markets actually dropping. Why would that happen in the middle of a bull cycle? That in my mind is a sign that the global stock markets are already advertising slowdown.
Well, I have a question for you. Do you think that the Fed will be responsive to slowdown in numbers, or do you think that they'll stay hawkish?
Well, this is the whole global de-dollarization problem, right? What happens is that the Fed is starting to, and more important, the whole United States is starting to take care of me first. And rather than playing the role of we have to provide the world with liquidity and everything, we have to be the global reserve currency. And what we're seeing here with them doing this is that there's massive dollar funding shortages, creating a lot of currency crises around the world. That will lead to problems. But the U.S., in my mind, is only going to respond when it starts to affect the U.S.
Okay, but how quickly will they respond?
I don't think they'll be quick.
Okay, so then if I would argue that if you believe that you shouldn't be trying to catch oil.
No, I'm trading it. I'm looking for a response. I'm looking for a $5 to $8 response the other way. That's not. There is no way.
You're playing a bounce. That's fine.
I'm playing a squiggle.
Yeah, okay, that's fair enough. But I kind of believe that if you think that the Fed is going to be somewhat tone deaf, or not tone deaf, but at least less willing to be accommodative at the first signs of trouble, then I think oil could go a lot lower. If you believe that. I personally believe that at the first signs of trouble, they're going to go the other way.
Well, I think we're going to have another dollar bet coming here.
Yeah, maybe next week. But I definitely think it's going to be something interesting to watch. And I think that oil might be more important to watch as the health of the global economy than most people realize. So if we do get a situation where this continues to go down, I think it might signal that the global economy is doing a lot worse than people realize.
Right. And what will be the big tell, I guess, is the magnitude of the bounce. At some point, there's going to be a bounce. No market just drop. Well,
except for 2015.
Except for 2015. Often there is a reaction. And there's going to be a bounce because short sellers get into a position where they want to lock in profits to create that short-term buying surge that creates the reaction the other way. It offers some sort of a move, and then if we see that rally fails, there's going to be room for another drop, and that's something that I'm watching for. Nonetheless, that's definitely a lot of the fun things to watch. The last thing I wanted to just very quickly, so I want you to just answer. What do you think of the oil service stocks, the Halliburtons and Schlumbergers? Let me actually put it up here. Just one last thing. Is there something that I'm missing? The fact that the Schlumbergers and Halliburtons they can't even catch a bid. They're like, what is there something terribly wrong here in your mind?
Maybe that's a sign that things are worse than we think, and the fact that the service stocks are doing so poorly is an example of something, an omen that we should be watching.
You think that they're like a leading indicator?
I don't know. I don't have an answer for you.
Because these are pretty sound companies, and the fact that the market is selling them off like they're GE.
You had to bring up GE, didn't you?
Oh, we'll talk about it in a moment. But yeah. Anyway, no opinion.
No opinion.
Okay. All right. That's all I wanted to hear. All right. So let's move on. Let's go to This Week in Trading History. So, Kev, what do we have for our listeners?
Well, this goes back to 1907. I think you chose it because you think that I was around then, although I have to tell you I was not. So I'm going to read November 6, 1907. Organized by J.P. Morgan, a boat arrives with $7 million worth of gold from London to help bail out the U.S. financial system during the Panic of 1907. The boat also brings word that $10 million worth of gold follows it behind with the, I don't know how to say this.
Lusitania?
There you go. You got it. I'm always counting on you for this pronunciation. The same boat that would be sunk by the Germans in 1915. The plan worked, although stock market would fall until November 16th when the Dow Jones Industrial Average would bottom at 3882.
Wow.
Panic in the markets would subside. J.P. Morgan had been monumental in saving the economy from the panic of 1907. The panic had begun on October 15th when Frederick Heinz failed in his attempt to make ketchup. In his attempt to corner the market in United Copper shares. Shares fell from $60 to $10, worse than our oil collapse, leading to brokerages failing, runs on many New York City banks, and a steep market decline. J.P. Morgan had been working for weeks prior to November 6 to help avert a crisis, most notably locking bankers in his office until they came together with a plan to help save the economy.
Sounds a lot like Bernanke in
Yeah, it really does.
2000.
It's funny how often history kind of doesn't repeat, but it does rhyme.
Well, the first comment I have, because I want to talk about an excerpt that tells the story a little bit better, but the first thing is that a lot of people they have a hard time looking past 1929. So 1929, the Great Depression, it's like somehow history stops there, and they don't go any farther back in the story. But what's interesting is that this 1907 period is far more accurately reflective of what happened in 100 years later in 2007, 2008 than 1929.
And I think Jim Grant has talked about that numerous times.
Absolutely. The 1907 crash was far more significant. Now, the 1907 crash started, or it was going through October. So, but it was the ships coming with the gold that was failing, that were coming in, where it was bailing out the banking system. What I thought was a really interesting to share, because I want to talk about this a little bit more detail, but I wanted to share from what is the best book in my mind, Reminiscences of a Stock Operator, Jesse Livermore at his best.
It really is fantastic. For anybody that has not read it, go out and get the book and read it. It is, and it's one of those books that if you haven't read it in kind of 5 years or 10 years, go read it again.
I've read it 5 times there.
Yeah, and every time I go back and I read it, and every time I'm a little bit more mature, although my wife might disagree with me, I learn something new each and every time, because it's little nuances that I missed each time.
Absolutely. So what I want to do is just quickly take a few minutes and read the excerpt from Reminiscences of a Stock Operator, when Jesse Livermore, who was under the alias of Larry Livingston in the piece, and was talking about what was happening during the 1907 period. I thought it was a great way to kind of get the boots on the ground feeling of what it was like there, and then we'll talk about it. So let me read this.
Sure, go ahead.
Things got worse and worse. Finally, there came an awful day of reckoning for the bulls and the optimists and the wishful thinkers, and for those vast hordes that dreaded the pain of a small loss at the beginning, were now about to suffer a total amputation without anesthesia. A day I shall never forget, October 24th of 1907. My friend's partner was as bearish as I was. The firm, therefore, did not have to borrow from my friend and the broker that I told you about, but fresh from seeing the haggard faces around the money post came to me. He knew I was heavily short of the entire market. He said, "My God, Larry, I don't know what's going to happen. I've never seen anything like it. It can't go on. Something has to give. It looks to me as everything is busted right now. You can't sell stocks. There's absolutely no money out there." He asks, "How do you mean?" He goes, instead of answering, he makes the classroom example of saying the experiment of a mouse in a glass bell where the air is being pumped out of the bell. And he says you could see the poor mouse breathing faster and faster, its sides heaving like overworked bellows, trying to get enough oxygen out of the decreasing supply in the bell. You watch it suffocate till its eyes almost pop out of its sockets, gasping, dying. Well, that's what I think the crowd at the money post feels like. And he goes on and says, no money anywhere. You can't liquidate stocks because there's nobody out there to buy them. The whole street is broke at this very moment, if you ask me. And then all hell breaks loose. And so what is he talking about? He goes, the president of the stock exchange, Mr. R.H. Thomas. So I heard later that day, knowing that every house on the street was headed for disaster, went out in search of a succor. He called for James Stillman, which was the president of the National City Bank, which is Citibank today, right. The richest bank in the United States at the time. And Stillman heard what the president of the New York Stock Exchange had to say, and then he said, "Mr. Thomas, we have to go see Mr. Morgan about this." And so the two men were hoping to stave off this disastrous panic. One of the greatest in financial history went over to the office of J.P. Morgan, and where they saw Mr. Morgan and then pled the case before him. And they said, moment he got through speaking, Mr. Morgan said, "Go back to the exchange and tell them that the money will be there for them." So where? From the banks. And so he goes on to say that so strong was the faith of all men in Mr. Morgan in those critical times that Thomas didn't wait for any further details but rushed back to the floor of the exchange and announced that the money is coming. So it goes on to say, I heard a day or two later that Mr. Morgan simply sent word to those frightened bankers of New York and said that they must provide the money that the stock exchange needed. And the bankers replied, said, but we haven't got any. We're loaned out to the hilt. The banks protested. And he goes on to say, but you've got reserves, snapped JP. And he goes, but we're already below the legal limit in terms of the reserves. Well, use them. That's what reserves are for. So all the bankers obeyed. They invaded the reserves, and to the extent of some $20 million or something at the time, big money back then. And they saved the stock market. It triggered the bank panic that came the following week. He was the man, JP Morgan. They don't come much bigger. But what's interesting about the stories is that what JP Morgan did was basically said, we got to bail out the stock market. They went and they basically lent out every last reserve that the banks had. And of course, the rumor on the street was that the banks have no money. And then what did it trigger?
It triggered a bank run.
It triggered the bank run back in 2000.
That's right. Which is why they had to bring the gold from London to prove that the money was there.
Exactly. And that panic was truly something special. That was that.
You seem to be saying that with like glee.
Oh my God! Yeah, I don't know about glee, but it's a really interesting piece of history because from all of this comes the birth of the Federal Reserve System, doesn't it?
These were the kind of the seeds that were sowed for in terms of making it so that this Federal Reserve was needed. Because why don't you tell me like?
Well, absolutely. So what you want to think is that after this bailout and this whole mess was averted, you had a situation where JP Morgan and the city guys and everyone were saying, well, listen, we're private citizens and we're private, and these are private banks, and we had to go and bail out the entire financial system to prevent it from failing. This is the responsibility of a central bank to do, not of a private bank to do this. And so that's where all of the Jekyll Island meetings occurred in the years that followed. And obviously, in 1913, the Federal Reserve Act was passed. It obviously took 6 years from this crisis to actually all be enacted. But it was really what happened during this 1907 period that actually gave birth to the Federal Reserve System that we know today.
So do you think that was a good thing or a bad thing?
Oh, you know what? I mean, listen, I've been inundated with so much of the conspiracy side of it that I don't know how you can say it's a good thing. But certainly, you know, I do have to agree in one element. It really isn't the responsibility of private citizens and private corporations to bail out a system. This is the whole point.
But were they really bailing out a system, or were they bailing out themselves? And was it not a crisis of confidence? And what was really needed was confidence. And you think of 2008, what really changed?
What makes China work today? Central planning.
So
right?
you're trying to say
but it isn't a central bank, the Federal Reserve System, central planning. It really is saying that, look, you know, there has to be some degree of everyone coming together, and there's one head of a snake, something that disseminates like a top-down pyramid, the way that the players have. So think about what happened in 2007, 2008. Ben Bernanke and Tim Geithner and all these guys brought together all the heads of the banks, and they said, you guys got to figure this out. We got to come up with a way of bailing out the system, and they did. And so arguably 100 years later, when the next, like, think about it, in 2008, some people thought that the next Monday that the banks wouldn't open.
Oh, there was some very smart people who thought that. Mohammed Al-Arian from PIMCO told his wife to go and get all the gold and get all the cash from the bank machine because he was convinced that the banks weren't going to open.
Right.
And so there was some very smart people that knew how close the system was to collapsing. The only thing that I would mention is that the fact that it's always based upon it's always a function of a belief, and the moment that belief goes away, you run into trouble. And so you need a strong leader to go and to say everything's going to be okay. We're going to keep making, propping this up and keep going. And so I don't. I'm not sure that a central bank is needed as much as not that it's not needed, but it's I don't think that that's really the issue. I think the issue is when people start sniping at it and try to start getting wrong with confidence. And I'm not the biggest Trump supporter, but I'll tell you one thing that I think he did do was that he actually went and instilled confidence in the economy, and I think that's really important. And I think that confidence equals in this kind of fiat money system is hugely, hugely important. And when people start, when credit starts collapsing in on itself, you need something to change that, because it very quickly overwhelms a system in a fiat system, and it can be really scary.
It's not going to take a boatload of gold at this moment to bail out the next time we have a crisis. So what happened here with this the ships of $7 million of gold, it's going to play out a little bit different this time around, won't it?
Because the U.S. doesn't have any gold.
Oh God! Now you're getting our.
I'm just kidding.
This is podcast number or show kidding. Number 1, and you're already getting us down this path. Let's not go there right now. Okay. All right. Anyway, so let's move on. So Kev, what do you have for the WTF video of the week?
Well, we have our good friends at Real Vision. Raoul Paul, the founder, one of the founders of Real Vision, had a video that basically caught me off by surprise. So I thought, well, let's just play it and then we can talk about it.
All right, sounds good.
And I think the most important thing to understand is that the rate of change of interest rates in the US, if I look at the 3-year on 3-year rate of change of LIBOR, is the largest in all recorded history.
No, God! No, God, please, no! 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 No!
All right, Ken. Okay. I'm sorry. We, before we go any further, we should say we love Real Vision, and if you don't have a subscription, you should go get one, because it's absolutely fantastic, and the interviews are just outstanding. I just watched one on Ross Beatty that Grant Williams gave, and it was outstanding, and we love them. But this video just made me laugh so hard, because Raoul committed one of the cardinal sins that I find all too many market pundits do, and it's talking about percentage change of interest rates from a low base. And
right.
It's just, so let's just stop and think about what.
So what happens if interest rates are negative and the rate of change goes from one negative to less negative?
It's like in Ghostbusters when they cross the stream, right? Like you can't, it just can't happen. And let me just explain to. I wasn't exactly sure what he was talking about with this 3-year. I knew his 3-year rate of change. I don't know what a 3-year LIBOR is, so I wasn't really sure about this. But why don't we pull up the charts that I kind of made that I think explain what was going on here. So this is Raoul's chart, and you can see that he's arguing that the percentage rise in the interest rate is the greatest in recorded history. Is that what he said? Yeah, something like that. So, and you can see that in his chart. It's up 750%. And so let's look at the next chart, which is actually the LIBOR. Now, I just took 1 month because I wasn't really sure what he meant by 3-year. I know he meant 3-year rate of change. But so he said in 1991, if we look at this, it went from 1 month LIBOR went from 3.25 to 6.25. So that was approximately 100%. So let's go back to his chart before. And you can see there in 1991, the 3 years, so it's like a few years past, and you can see it's 100%. So then in 2003, it went from 109 to 539, which is the 400%. And let's go have a look at roughly. I'm just using round numbers, and you can once again see Raoul's thing. So then he goes and he points out how this latest one is 750%. So you're thinking to yourself, wow, that must be quite the increase in rates. And I'm thinking 1970s Volcker kind of cranks the rates.
And Volcker's out with his hammer.
And then you go look at this and you realize it's because you started at 0.19%. So it went from 0.9% to 2.33%. So yeah, it's a huge percentage, but as you approach zero, it's
right. So if we went and we reached point
0.0001.
No. Let's just say even just 0.1.
Yeah.
So 10 basis points.
Yeah.
And we went from 10 basis points to 50 basis points. It would be the largest percentage change in recorded history.
Right. So using percentage change on interest rates is just
in your mind, it's not.
Well, yeah. So I don't. Now, I understand the argument that when it goes down there, you can borrow a lot of money at a low rate. So it really does. It still affects. But I don't think that that's how the world works. And I always there's a famous Fed model that basically takes the interest rate and it puts it into the fair value for stocks. And I figured it out one time, and as interest rates approach zero, stock market fair value goes to infinity. And then I don't know what happens at negative.
It's infinity and then beyond,
yeah.
right? Like, there was some sort of
Buzz
movie
Lightyear. Buzz Lightyear. Okay, let's have another. Thanks again to our sponsors. Bob Cajun Brewing Company for Birch Bark. Anyways, let's move on. Thanks a lot.
All right, Kev. Time for Tales from the Trading Desk. I shared last week the Nortel thing, so why don't you start us off here? What's your tale from the Trading Desk?
Well, I have one that's not so much in history and is actually happening today, and it was actually Thursday. There was a big print on GE after the bell. And
so GE being General Electric.
That's right. And
so we're going
at one point, the largest stock in the U.S., I believe. It's been a while since then, but now it's just... Again, it looks worse than the oil stocks, and it's just been getting hammered and hammered and hammered. On Thursday, it was trading at 9.10. It closed at the lows of the day, and all of a sudden, in the after hours, there was a huge print of 370 million, or no, sorry, 37 million shares, which is a big
shares.
37 million shares, a big print, and
in after hours.
That's right, and that was a new low for the day, and a new all-time low, or not all-time low, but a new low for this move at the time.
Are you sure that's not 370?
No, so it's 370,000 shares.
Yeah.
So it's
okay.
37 million shares. That's right. Am I wrong?
Yeah.
Maybe I'm wrong. I don't know. It's a big print. And there was lots of kind of talk on the street about what this was, who was selling, why they would do it after hours. And I was hoping at the time that it was the tail end of the selling. And let me just explain to you how it, on an institutional desk, how it works. Often when there's a big seller, it will take days, weeks, sometimes months to sell
it all.
Sell a position.
Yeah.
And sitting on that institutional desk, everybody knows it. And in fact, a lot of times other people on other desks know it, and they know that the seller's there, and they know what his position is, his or her position is, and they're just waiting for them to be finished. Yeah. And I was really hopeful when this happened Thursday night that was the final print and that they had actually cleaned up the position. And to me, that was they kind of had all the telltale signs, trading something at 445 on a big print after hours, something that they've been working on for months or weeks. And I thought it was that. But then guess what? Friday came and the selling just continued.
It's ugly, isn't it?
Oh, it's terrible.
You know what? I have to admittedly, I feel shame for now having touched the stove 4 times and getting burned. I have only 2 more times to touch the stove with crude oil to get burned as many times as I've been burned with trying to catch the bottom on GE. This thing has just not worked for me. They cut their dividend, was it 1 to 1 cent? Like, it's basically 0.
That's
they just
right.
kept 1 cent as a token thing that they have that they still have a dividend, but they cut it. What's going on there?
Well, I was hopeful. There's new management, and they did this big cut, and they announced their earnings, and I was hopeful that it was a kitchen sink kind of quarter. They threw in all the bad news, and that you get it all out of the way.
Like Barrick did in 2013.
Yeah,
how did that work out?
And you just throw in all your bad news, and you do it, and everything was going well, and it actually traded up on the news, and then as they went along, it was announced that they had an account. The SEC was in there about accounting. And when you have that, it just becomes something that makes it unbuyable for institutions. And I was hopeful that they would stop. Maybe they wouldn't buy it, but they'd stop selling. But that's not the case. They keep selling. And, back to this big print, you go look. One of the things we're showing the list of all the holders. And one of the things that the first two are obvious. They're Vanguard and BlackRock, big indexers. And that's kind of long-term money.
But GE's still in the S&P 500.
Oh,
right?
for sure it is.
Yeah,
It's the large company. But one of the things that scares the bejesus out of me is the fact that GE Retirement is the third biggest holder. And if I'm running
so much for your retirement
fund,
if
I was running a pension plan, increasing exposure to the person who funds your retirement is not the best thing. I think Enron was the same way. It was just it just kind of boggles my mind that they have such a large position. I don't know. Maybe that's not a large position of their actual fund, even though it's 334 million shares. It's become a lot less large than it was earlier.
Yeah.
But going back to the problems with GE, as I was hopeful that as they got 2 downgrades on their credit, and I was hopeful that was going to be the bottom. And then combined it with this big print, I was trying to think, oh, boy, that's it. But the reality is that the selling just continues, and the real question is, are they going to be able to maintain their credit rating without issuing equity?
Are they junk yet?
No, they lost their A and they're into triple Bs, and so now.
Wow, the stock is getting killed this much, and they're not even.
Yeah, and today the bonds went. They were offered, and they were getting sold hard, and I think
someone smells something.
And if they can't fund through the fixed income, if the bonds get into trouble, then the stock doesn't have a chance. And they're going to need to issue equity, and I can only.
They're going to go Elon Musk.
Yeah, I can only imagine that these sellers are smelling an equity issue coming, and I think that it probably has to come sooner rather than later because they need to shore up their balance sheet.
Well, like if you look at this chart, it's. I'm going to put on a weekly chart just so that we can feel the pain. Like, wow.
Yeah.
I mean, from $34 basically down to $8, and it just doesn't feel like the end is. Now, obviously, if you want to buy the bottom, you have to buy when there's blood on the streets and nobody sees the light at the end of the tunnel yet. If you want the absolute best price, the question is this worth trying to catch the bottom on, or is it better to let it play out? Like, every market cycle has a story. So, it was Nortel in 99, 2000. Then you had your research and motion and bank stocks and Lehman's during the 2007, 2008. If we are going to go into a bear market, I don't want to say that we already are, but if we go into like something, there's got to be
a surprise. There's got to be a surprise that no one was expecting, nobody was talking about.
Absolutely. But at the same time, there's always those stocks that were the darlings of that era, and the investors just get murdered. Now, I've always been a candidate believing that it's Elon Musk that is going to be the poster boy for this.
Oh, really?
But I might be wrong. I might be wrong. I'm not. But I'm certainly going in the Chanos camp. He's got a good track record. For
Chanos is one of the best.
Yeah. Absolutely. And so, when he's determined that that Tesla's worth zero, it's kind of a bad bet. Anyway, we'll talk about Tesla another time.
Right.
But the point is, what if GE is one of the kind of the poster stocks of what will end up being the stock? Like, think about it. That GE was one of the original stocks in the Dow Jones. Back when Charles Dow was writing and creating the Wall Street Journal, and he wrote, he put together the industrial index. Like literally, I mean, it was before 1900. I think it was in the late 1800s when this was happening.
Even I wasn't around then.
Even you weren't around there, and you had hair back then.
That's right.
And so you had a situation where that was one of the original stocks.
Yeah.
What if? Now I'm not predicting. Listeners, do not take this as a prediction. What if this is the beginning of the end of this stock?
Yeah. Well, I thought the same thing today in terms of when I saw the bonds go no bid. Well, not no bid, but I saw them getting hammered. And to me, when the credit market gives up on this, it's not long for the stock market. It just that kind of disconnect can't continue for long because these guys have a lot of debt outstanding, and if the bond market gives up on them and won't fund them, then there's going to be a lot of problems. I still hope that that's not the case. I'm still hopeful that this was the bottom and that we just had one day of.
You got your Teflon or chainmail glove on?
No, I'm not. I am long, but I'm not as smart as you in terms of owning the puts. They're too expensive for me. Anyways, on to the next thing.
Let's move on.
Now on to my favorite part of the show. We're going to do the top 5 things to watch next week. Number 5, what are you looking for, Pat?
I'm looking for what's happening with Home Depot. I'm going to, in particular, its earnings. On Tuesday, November 13th, in the morning, 9 a.m., we're going to get the earnings. What's interesting, you were talking about the home builders last week.
I was getting laughed at by your members.
Yeah, absolutely. You're, for sure. But now there's a big difference because there's the actual home builders, and then there's that home builders index, which is ETF, which actually surprisingly has very few actual home builders in the top 10. There's all the Home Depots, Lowe's, all the Johnson Controls.
And there's a good
Whirlpool.
thing you should always look at what your ETF owns because XHB, which is a home builders index, the S&P one, is the top 5. There's only one home builder.
Yeah.
But meanwhile, the ITB is nothing but home builders.
Right.
But regardless, we're going to have the Home Depot earnings.
So what to me will be interesting, like, okay, Home Depot, let me just quickly show, got murdered to the downside. I mean, no, listen, it did have a big rise, so it checked the rise with a pretty steep drop from 215 down to 270 or so, and now we got a reaction. What will the earnings bring? Because if the earnings are positive and we see that it's like heading back to 200 on the upside, then they can gain some traction. But if it gets hammered and goes Caterpillar or something like this on the downside, then it may be a little problematic. So I'm watching Home Depot. What's number 4?
Number 4 is Nat Gas.
Wow,
Nat Gas has been just on fire lately, and it's been taking off. It's one of these things that's below the radar of a lot of people. For people that don't trade it a lot, it's one of those commodities that's very difficult to own because of the shape of the curve.
Yeah.
And the carry is
huge carry.
It's huge carry. And I saw this great post by a quant trader, and I'm going to write it up next week, that said for the first time in X number of years, actually rolling the front month, over and over and over again has not been a loss. So
What?
I see Nat Gas, and I'm wondering if it's bottomed, and I'm excited about Nat Gas, and I actually really like it.
Isn't it interesting, that oil and gasoline are going the opposite direction, even heating oil is going the opposite direction than nat gas. So there's a complete, so we got nat gas making literally 52-week highs. And we pretty much have those markets. I don't know if they're making 52-week lows, but they're pretty close to making 52-week lows.
But
big divergence,
and
right?
You're out. That's right.
What's interesting is that I always say that things like oil is a very international market, while natural gas is a very domestic market, like weather-driven, all sorts of different variables.
And
like
it's
that, right?
just been brutal, beat down. It's been terrible.
What do you make though of the fact that the natural gas stocks have not responded to this?
Oh, but I think interestingly enough, I noticed that Encana, SAC, which is this, it's not SAC anymore. Steve Cohen, I think it's 0.72. He just took a huge position in Encana with this takeover of NFX.
All right.
I guess for the record, I'm supposed to say I'm long both Encana and NFX. So I think that it's something to be watching for, and I look at the natural gas, and I think it's something that's off the radar of a lot of people, and it definitely should be on yours. What do you see for number 3?
Well, for number 3, I'm watching the dollar, and is it going to print new highs? To me, one of the most important things that I was thinking that in order to have a meaningful rally into the year end for the stock market, I was under the thing that would have worked best is a dollar consolidation, a period where the dollar was not trending higher and pushing new highs. To me, new all-time highs on the dollar is risk off in terms of a lot of the different types of metrics within the markets, particularly commodities will be under pressure, all sorts of things. So if this dollar breaks out to fresh new highs for the year above 97, I think we can't ignore it. And with us literally almost making a new high right now, I think that is the thing to watch next week for number 3.
And I will go further and actually say that I think that a dollar decline would have been the best chance we had to actually getting a risk-on rally in the stock market.
I agree.
And even though the Brent Johnson Santiago Capital milkshake theory says the opposite, I'm firmly in the other camp, and
we have Brent coming out to the Macro Voices.
He's
live,
super nice guy, even though I don't,
he's
and he's one of those guys that it's easy to disagree with him because he's so nice and he's willing to entertain different ideas. But I'm definitely on the other side of the camp.
Yeah, the dollar rally's not good. I wanted to give one lip service to Canadian dollar, which when you have the CAD basically looking like it's completely rolling over. And it's interesting because the Aussie is not actually breaking the same way as the CAD. I've been actually personally quite bearish the Canadian dollar for a while. And this could probably be stimulative for Canada if we're obviously not happy about, if you own too much Canadian dollar.
But don't forget, we're a petrocurrency to a large degree.
Yeah.
And I'll show you a chart. Maybe in another episode, I'll show you a chart between the U.S. versus Canadian 2-year yield and the price of crude oil. You can explain like 80 or 90% of the Canadian dollar.
I would love to see that. That's actually for a future episode. One way or another, while we're watching the dollar index breakout, I want to see whether or not we get a breakdown there. So that's what we're watching for number 3. So Kev, why don't you tell us what's number 2 on your list?
Number 2 is the yield curve. And I know that a lot of the equity people kind of roll their eyes when I talk about the yield curve, but I really think that it's going to be one of the big trades for the next financial crisis. And I look for a yield curve to eventually go to all-time wides.
So which one do you want me to put on?
Why don't we put the 530s? That's the one I like, but it doesn't really matter.
Okay, so here's your 530. So we had quite a steepener in the last month. There's no denying
It's been kind of 3 years of it going straight down. We finally bottomed.
That's been the growth story.
We finally bottomed, and I looked at this last week or so as a great opportunity. Why don't you do your Fibonacci squiggles or whatever?
You want me to do Fibonacci's on
here? Yeah, because
here.
to me, I looked at it and I said, "Oh, this is just a nice correction in a new steepening trend." So we'll see whether I'm correct.
You're almost a 50% retrace.
There we go. So I don't, you can tell me.
You know what? While I agree with Fibonacci's, I don't know whether that's going to be the sole driver here. But I'll tell you, I agree with you. The yield curve, are we back in a steepener? Because we had Charlie McElligott on the show at Macro Voices, and he said, don't fear the flattener, you fear the steepener. And I don't know whether you have a comment on that, but generally a steepener is you have to change the composition of your portfolio, right? Like what works in a steepening period, often that's a very risk-off period when there is a steepener. What's your take on that?
It is complicated because the question is why we're steepening. And
bear steepener or bull steepener,
That's right. And I contend that too many people think that this is going to look like the previous kind of situations. They're imagining 2008 or whatever. Yeah. I was laughing with you in the car when we were driving. By the way, everyone, just for a little update, I gotta tell everybody. Patrick drives a Hummer, and like what is it, like a 19? Or no, sorry.
2003. It's an old
2003.
beast.
And when he picks me up, sometimes when I just kind of laugh at this car. And today he couldn't pick me up because it had a flat tire, which isn't usually that big a deal. But this thing is so old and rusted that...
Oh, my God. It's not rusted, but anyway.
It was so old and rusted that they couldn't get the tire off. Well, why don't you tell the whole story?
Anyway,
Oh, no, he doesn't want to.
I'm not going to tell the whole... It's ugly. It's ugly.
Okay, so the long and short of it is that Patrick started talking to me about the fact that the economy might be rolling over and the global economy, but and he started talking about that's an excuse to be long bonds. And I said, well, not really. I actually think that if we get an economy rolling over, that the 5s or the 2s will do a lot better, and you could see a situation where the 10s and 30s don't go anywhere. So I think it's increasingly important to understand the different tenors of the curve and to trade those, because you could find a situation where the economy rolls over and yet bonds don't go up, and that's what I'm looking for.
So what I want to do, let's make a note of it to talk about it in next week's show. But I want to talk about inflation. I want to talk about the impact of these dropping commodity prices, and we really should touch on this whole idea, because I personally am in the camp that you are making fun of here. I personally feel that generally that there'll be disinflationary pressures and there's room for the long month, but let's save that for next week.
Sounds good. Without further ado, what is the number one thing we're watching next week?
It has to be crude oil to me, and whether or not we bottom here at the 60 level. I mean, it's a round number in the 60 level, but there's a lot of support lines that are actually coming in on crude oil around these levels, right? I mean, we're just a little bit below there, but let me just put up a chart just to show the relevance of some of the prices. Particularly, there was a key low that came in around this $58 to $60 level. It's more of a range. It's never exactly the price print. But the point is that earlier this year in February, we put in a pretty big bottom in this area. With us so oversold, there should be some reaction. I'm not trying to say a new bull run or something. That it should be a reaction. If we rip through 60 in this area to the downside, like if it just didn't matter, that means something 2015 crazy is happening. And so there we are so oversold, we should get the reaction. So will we? I'm watching next week to see what happens there.
Okay, sounds great. And so that's it for the show. Thanks for listening. And we're going to leave you with a little parting trading wisdom. And this is something that I got from a guy that used to be the head trader on the Toronto Stock Exchange floor for my firm. And way back when there was actually a floor. And he used to say, slay your dragons while they are small. And until you've actually traded, and you really won't understand that. But for those that have had positions that have gone against them, they understand that they're easy to deal with at the beginning. And as they get bigger and bigger and bigger,
they own you.
Yeah, and they end up being more and more difficult.
Career ending.
Yeah, and so he always thought this, slay your dragons while they're small, and I thought that was the greatest expression. I'm Brian, if you're listening, thanks for that one. I've always kind of kept it close to my heart.
Absolutely.
Anyways, it's been a great show. Thanks for listening. Look forward to next week. This is our first one. You can watch us on YouTube. You can follow me at Kevin Muir on Twitter. And Patrick, where are you on Twitter?
You're also at Patrick Ceresna as well. You please follow the YouTube channel. We want to build some subscribers. Obviously, this is our first official episode, so we're right off. But why don't you become our first YouTube subscriber, but help us spread the word. Make sure you, if you like this episode, forward it on to all your friends. Help us make this show go viral. We hope you're enjoying it.
That's right, and a big thank you to Bob Cajun Brewing Company for the Birch Bark beer. Did you enjoy that, Patrick?
That was actually really nice. I mean, listen, I normally am not into this IPA stuff, but it was actually not bad.
You know, I loved it, and you got to stop saying that our sponsors are not bad. You have to say they're terrific.
They're terrific.
Okay.
It was fantastic.
And for our American listeners, go listen to Bob Cajun by the Tragically Hip. Without further ado, thank you very much. Take care.
All right, take care. Thanks, everyone.